Yeah, I think overall, Jeff, it's going well. If you look at EPS growth on average, I think 3/4 of companies have reported. We're looking at 11%. The majority of companies are beating earnings expectations, and actually an even larger majority are beating sales. What you're clearly seeing with some of the reactions this morning, though, is there's a lot of differentiation. Companies that are beating being rewarded, companies that are missing being hurt, and I think those reactions are a bit larger than we've sometimes seen in the past.
What conclusions are you drawing from these earnings reports as to where opportunity lies then for the second half of the year for investors?
Yeah, I think what it's telling us is that momentum is still strong. We are still seeing good top-line growth. There's been some nervousness about some of the European economic numbers. Recent trajectory has been a bit better. I think the key message, Jeff, is you need to be selective. It's clearly saying the opportunities aren't everywhere. You need to pick your spots.
What are your screens telling you at the moment, and what are you screening for at this point?
In terms of
ROE, EV to EBITDA, I mean, how are you trying to assess where the potential actually lies in a lot of these companies? Because we're seeing some okay reports, as you point out here, but not a lot of organic margin expansion in some of these businesses, and a lot of the blue chips are getting roiled a little bit by FX headwinds.
Sure. So we tend to look for companies where we think the longer term return opportunities are attractive, and that can come from many different places. So the main lens we use in our own portfolio is internal rate of return, and of course that can be around margin expansion, it can be around top line growth, it can be around a number of different metrics. And I think it's a bit of a problem potentially to pay too much attention to, well, this quarter it's really ROE that the market's focused on, next quarter it may be a different metric. So we tend to take that longer term, what are the cash flows a company can produce, how are those being valued, what's the return that company offers over a kind of 3 to 5 year horizon.
Nick, on the FX issues, it was interesting to hear Mark say it's premature to say that it's turning to a tailwind when it comes to the euro-dollar rate. They are talking about a stabilization here, but given the trends and expectations for more US dollar strength, do you think, in fact, the earnings season ahead, this will start to be a real boost?
Yes, so you're absolutely right that those correlations between currency movements and equity market performance can turn quite quickly. If the market is worrying about Eurozone stability, then you tend to get weak euro and weak European equities. More recently, it's definitely been a tailwind, and I think there's no particular reason not to expect that to continue.
And when we talk about what's going on in the UK market, we've seen the FTSE getting a bit of a boost here from the sterling just constantly going lower, at least over the last 2 days, now at a 1 year low against the greenback. How do you play this? I mean, yes, the outcome still with Brexit seems so binary. You have to wonder, are people getting ahead of themselves, anticipating the worst case scenario?
Yeah, so again, I think the key way to pay attention to that is to understand how movements in the exchange rate affect the earnings of particular stocks. But it's certainly been interesting that the way the markets are, if you like, playing the news flow on Brexit has been through the pound, not through the UK stock exchange.
Do you think a lot of this is noise rather than real signal? I mean, how do you put the political risk element into your portfolio construction?
Yeah, I think the difficulty with political risk is most of the time it is noise until often very close to some key event it becomes a bit more than noise. And I suspect Brexit will be just like other political news in that respect. Very hard to forecast. You know, when we get to the kind of October-November period when the two sides have to conclude a deal, if it's really looking at that point that a chaotic no-deal Brexit is likely, then I think we're likely to see equity markets react a bit more. Central case of a more soft Brexit in line with what Theresa May's proposed, I think it'll remain more background noise.
Can I ask you about planning? Because there was a line from TUI this morning and they say that it's basically their duty to prepare for a worst case scenario. Do you think it is the duty for corporates right now, or the listed companies that might have some exposure, to prepare for a hard Brexit so shareholders, investors are protected?
Well, I think that's what companies are doing in practice. I mean, if you look at our own industry, obviously we need to understand what the impacts on our ability to sell mutual funds around Europe and in the UK will be. So yes, I think companies have a clear responsibility to their shareholders to prepare for plausible eventualities.
Which tells you a lot about wasted resources potentially if there isn't a hard Brexit. If a deal is cut last minute, that all these companies have spent so much time and effort, plus money, to prepare for something that's not going to happen.
Well, I don't think the outcome is binary. There are clearly a range of different options, and different industries will be affected in different ways. So, clearly how far an individual company needs to prepare will depend on what different outcomes mean in their particular industry.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.